All right, folks. Welcome to Finance Friday. You're here with Earl, the money coach, and we're going to be talking about life insurance, but not just life insurance or one kind of life insurance. I want to break down all five different life insurances out there, the history, the pros, the cons, and just a few things that you can kind of use for yourself to make the best decision on what insurance is great for you. But before we get started, if you're not a follower, make sure that you like, comment, and subscribe, and always check the description. I have how you can get instant approval on life insurances. That way, it really could help you out in as quick as 10 minutes. But let's get started because a huge problem when it comes to life insurance is most people don't understand the differences, what they're used for, the pros, the cons, which one could be best for you, or possibly to have both. I always tell my clients that you need to have a blend of both, of your term and your permanent. Why? Remember this: term insurance gets you to retirement, permanent insurance gets you through your retirement. Okay, so you get your term when you're younger, in your 20s and your 30s. It gives you that 30, 35-year buffer. So if anything happens, God forbid to you, your family is secure. They're taken care of. Now you have your living benefits. You have those things that can help you out if you have your heart attacks, your strokes, your cancers, long-term care. You have some of that assistance with the term insurance as you're getting towards retirement. Now, the permanent insurance, you want to get during the same time, but able to use that cash value to be able to grow for you. So that's a great strategy, but let's break down the basics. Let's give you the history of life insurance because unfortunately, most people only know two. They know term and permanent, but they don't know all five. Folks, there's five kind of life insurances out there. You have your term life insurance, your whole life insurance, universal life insurance, variable universal life insurance, and index universal life insurance. Five different kinds, all are structured a little bit differently that could benefit you. But let's go through the history. Whole life, that's the first insurance that came out. Your whole life insurance is pretty much exactly what it sounds like, to be there for your whole life, to be able to have it for anything that happens as soon as you get it all the way till you pass away. But generally speaking, most of us know that life insurance, when it comes to whole life, is very expensive, super expensive. It generally costs the most. So you know how people are. They look, man, I don't want to have to pay all that. We need to find something different. That's when term life insurance came out. They said, look, whole life is the most expensive. Let's get something that's the most affordable. It's your term life insurances. So most of you know that could go anywhere from 5 years up to 35 years. But generally speaking, you see 10, 20, or 30-year terms. You could get a 35-year term. Some companies even have something called an age 65. So meaning if you're 18 years old, you could get that term and it'll go all the way to age 65, which is over 35 years. So everyone has something different. But the thing is, remember this: 98%, not 5%, not 30%, 98% of term life insurance does not pay out. They do not pay out. Why is that the case? It's because, very simple. Number one, most people outlive their policies. I got my first term life insurance when I was 22 years old. So meaning by the time I hit 52, God forbid nothing happens to me, it's gonna expire. It served its purpose. So that's a huge thing. Most people outlive their term life insurances. And then the second reason why 98% of term life insurances do not pay out is because they lapse. People forget to pay them, or they may have something that happens that may change their banks or change something where a lot of times you just see policies have lapsed. So you want to make sure you're following up to make sure all your stuff's up to speed. So what happened was you had whole life came out first, then your term life insurance, and people said, look, it's great, it's affordable, but when I have that 30-year term expire, now I'm older. For me to renew and get another term life insurance, now that I'm older, is cost an astronomical amount. Way more. I was paying $30 a month for a term insurance. Now I'm paying $300 for the same amount of coverage. So that's what happens. People say, look, hold on a minute. We want to have something that could be affordable and it can go for our whole life, but we don't want to have the whole life strategy. That's where universal life came out. Your universal life insurances came out. It was kind of the midpoint. You had the most expensive with your whole life. your most affordable, your term life. Universal life is pretty much what came out in the middle. So they said we want to have something that has a little bit of the pros of your whole life, but since it doesn't cost as much, what do you think that means? For the cash value side, it didn't grow as much. A lot of whole lives, they have, anywhere from 3% to 7%. It's something that's fixed. So, hey, no matter what happens, you're going to get 5% every year, 6% every year, whatever that may be. But universal life, since it didn't cost as much, they said, look, if it's not going to cost as much, it's not going to be able to grow as much. A lot of your universal life strategies, they'll have 1 to 2%, maybe 3% if you're lucky. So it costs less, but the growth was less. And you know how we are. We say, all right, man, look. It's not growing the way I thought it was. It's not growing like whole life. We need another strategy that could give me all the money. Because, people are greedy. So what came out next was variable universal life. You had your regular universal life, then you had variable universal life. Now, what is variable universal life? It's the only life insurance that's officially attached to the market. Every other life insurance, even though the money grows, it's a reflection of the market. So if the market does a certain percentage, your life insurance can do a certain percentage. But with your variable universal life, that actually is in the market. So if the market goes up 20% this year, your money goes up 20%. All right. In 2022, when the market dropped 19%, your variable dropped 19%. So you had all the high risk, the high rewards, but you also had some of the losses. But it's what people wanted. Universal life wasn't enough. It was giving you 1 to 2%, not that much. So they said, we want something that has a lot more. That's when universal life was no longer the option. Variable universal life came out. So over time, as you see, insurance has changed. You had your whole life, which is super expensive. Then you had your term that became affordable. You had your universal life, which kind of like the mix of both, but it wasn't getting a lot of growth. So then variable universal came out so you could get a lot of growth. So now people say, all right, look, we got 4 different insurances. How can we have something that gives us all the good of everything and eliminate some of the cons? And that's where the last insurance came out. That's your IULs, your index universal life. What they did is it's still a universal life, so it doesn't cost as much as whole life, but they wanted to make it so you have a little bit of all the features. So you have some stuff like your term life insurances where your IULs have living benefits. Anything happens critically, chronically, terminally, you could access those funds. It had it for your whole life, just like your whole life strategy, but also it had a blend of the variable. So how the IULs work is they are a reflection of the market, but they have a floor and a cap, meaning there's a cap at certain companies. They may have, say, 13%, 15%, 17%. So if the market did 20% this year, you're going to hit that cap. So it allowed you to have a lot of the market, but the reason why is because you have a floor. And generally speaking, 0 is your hero. Okay, meaning if the market were to crash 30%, the market 2008 dropped 40%, 0 is your hero. You're not losing anything. So that's kind of the trade-off. You may not get all the gains, but you're not getting any of the losses. So you had it over the years, your insurance has evolved, but understand, a lot of people don't understand that these insurances, when it comes to IULs, it's not set like a whole life. Meaning a whole life is, hey, you're going to pay $300 a month. That $300 a month you're going to pay for the rest of your life into your whole life strategy is going to start growing money. They call it accumulation, the cash value. You're going to start getting some accumulation in your cash value, all as well. But in the IULs, they said, listen, we're going to give you a structure where you can use it like a saving strategy, where you could put in a little bit more. You could put in $300 as your minimum, but then you also could go up to, say, $1,000, $1,500 for your maximum. So it gives you a range of what you could do so you could start investing. Or not, take it back, not investing, you could start saving. Because remember, I just corrected myself. Life insurance is not an investment. It's a saving strategy. Okay? Life insurance is not an investment. It's a freaking saving strategy to make sure that you could actually save but get some of the gains of the markets as well. So it's kind of evolved over the years, but there's pros and there's cons for all these different things. So IUL is your index universal life. A great pro, you never lose money. Everything's growing, is growing great. It's awesome. But you do have cons. Some of the cons in your IULs are, guess what? They have to be structured correctly. Most people don't structure them correctly. Yes, in that example I just gave, the minimum was 300. The maximum could be up to 1,500. Most people and most life insurance agents, they're just talking about it's $300 a month. You pay that, you're good to go. It's not how it works. With your IULs, your Index Universal Life, you want to be what we call overfunding, putting in more, using it like an actual saving strategy. If you're just paying the minimum or the target, as it's called, what's going to happen is you pretty much brought yourself at a very expensive term because you're not using it the way it's supposed to be used. They are designed to be overfunded. If you're not overfunding your Index Universal Life, it's not going to work correctly. It's not going to be structured correctly. You're going to see there's going to be a cost of insurance. It's going to take you 12 to 15 years to take care of that cost of insurance up front because you're not overfunding and funding it correctly where you could take care of all that cost of insurance in the first 4 to 5 years. So there's going to be pros, there's going to be cons. All right. Now, one other thing you have to understand, not just with the IULs, but all your permanent, which is your whole life, your universal life, your variable universal life, and your index universal life, they all have something called a loan provision. A lot of people ask me, hey, Earl, what are the taxes? What are the penalties? What are the fees if I want to touch the money early for your retirement? Well, they have something called a loan provision. Loan provision is how much you're going to have to pay to be able to access your cash value. And some whole lives I've seen anywhere from 3 to 7%. I've seen a few companies go 8%, but generally speaking, it's about 3 to 7% in your whole life. A lot of your index universal life and your universal life strategies are a lot less. You know, if some of your index universal life is regularly about 2 to 2.5% for the first 10 years, then you get credited back, kind of like a wash loan. After 10 years, they're going to credit you back, say 2%. So it's only 0.5% to take your money out instead of having that, anywhere from 5 to 7% in your whole life strategy. So you have to understand and use it as a balance to make sure it's good to go. Whole life is a great strategy as well. If you're looking to have a guaranteed, if the market goes up, the market goes down, doesn't matter what's going to happen. My whole life is giving me 5% guaranteed. So you have a safety net. You have that range. Your IULs, they're not locked in. Even though you have a floor and a cap, if the market does say 6% this year, you can get 6%. Next year, may do 13%. You'll get 13%. The year after that, the market crashes, you're going to get 0. While your whole life would have just been giving you 5%, 5%, 5% in this example, steady on. So you want to make sure you're using them correctly and knowing what's the best thing for you and your specific needs. Because there are different ways it could be used that could benefit you. You hear a lot of times now your family banking, your infinite banking, how to become your own bank, being like the Rockefellers. And the debate is what's better to use whole life or index universal life for that strategy. So it could be structured correctly. That's a huge debate. I'm not going to get into which one's better. You want to make sure you're using it correctly if you're going to be using it as a family bank strategy or as an infinite banking strategy. And for those that don't know what a family banking is, or if you're doing infinite banking, it's when you could front load your insurance. You could have, say, $100,000. You put $100,000 into your life insurance. You could take out a large lump sum immediately up front instead of slowly having to wait for that money to accumulate. But it has to be structured correctly. Most of the time, you have to leave at least 5% into your account. So meaning you could take out up to 95%, but that's after you talk about your cost of insurances and all that being calculated. So what I just said, if you had $100,000, a lot of people think, oh, I could touch 95%. That means it's 95,000 I could use. That's not the case. You have $100,000 that you put in, but the insurance still has a cost of insurance. Let's keep it simple for this hypothetical. Let's say it's $10,000 for the cost of insurance for having such a large policy. So you got $100,000 you put in minus that $10,000 for the cost of insurance. That leaves you with what? $90,000. Then out of that $90,000, you could touch 95% of that. That's huge because a lot of times people have stuff structured trying to do family banking for like flipping homes, duplex real estate, and they get messed up because it's not done correctly. So you want to make sure when you hear your family banking strategies, how to do that correctly. If it's your whole life, if your IULs, your index universal life, the way you have it structured really matters. So that's one of those cons we talk about when it comes to insurance that a lot of people don't tell you about. They start talking about a lot of these strategies, how you could save money in insurances, but when they say these strategies, it's not telling you how it needs to be structured, how it needs to be done correctly, and how to make sure you can have it benefit yourself. Because if it's not structured, some of your IULs, your index universal lives, so you could have it overfunded, you're going to find it's going to take you a lot more years. Or a lot of times when you see insurance agents will show you, look, by the time you're 65, you're going to have $700,000 of cash value. That's correct if you overfunded and put more money in than just the target. So you have to make sure that you're using it correctly. My advice always is to sit down with your insurance agent at least once a year. So you could always review to make sure everything's going correctly, make sure everything's good to go in these kind of strategies. And then also, since there's 5 insurances, like I said earlier, a whole life, term life, universal life, variable universal life, and index universal life, 4 of those 5, most people could do, because that's a regular insurance license. But if you want a variable universal life, a VUL, since that's actually in the market, you have to have a licensed professional that has a series 6, series 63 in licensing. And what that is pretty much a securities license, because that specific insurance actually is in the market. So you need to have someone who has a securities license to take care of that. Now, is that the greatest strategy? It's a good one. I have one of those myself, but I have different ones you can use, which brings me to my next portion of what we're talking about is which insurance should I have and how much do I need? Well, understand, like I said earlier, you could have multiple, you could have both. Term life insurance gets you to retirement, permanent life insurance gets you through retirement. So that means you could use both of them at the same time. And a great thing to understand, if you want to know what you could have, generally speaking, is 30 times what your income is. So let's say you make $80,000 a year, 30 times that 80,000 is 2.4 million, meaning without any problems, you should be able to qualify for at least $2.4 million of life insurance, because they're going to factor in what your income is. So why is that important? Because you could do a lot of different things. You could have a $300,000 face amount for a permanent insurance that you're using to fund for retirement. Then you could get a $500,000 term insurance just in case something were to happen to you. For me, myself, I have 4 different insurances because I'm using them for different things. I have term insurance, so God forbid something happens to me, it has living benefits, I could dip into that. I have my permanent insurance. One of them is for my retirement. Another one is to take care of all my expenses. If I pass away, God forbid, my beneficiaries will use that specific insurance to take care of everything. And then I have another life insurance, which I use for tax purposes. There's something out there called the Section 162 executive bonus. Now, what is a Section 162 executive bonus state? It allows you as a business owner to be able to legally write off up to 50% of your taxes within your insurance. And that's huge. Just had a client yesterday, we were sitting down, he spends about $120,000 a year on taxes. We're going to use in the life insurance and the Section 162 executive bonus to be able to write off 60%. To write off, I'm sorry, 60,000, which is half of what he actually has for their actual tax purposes. And folks, that's huge. That's what a lot of folks could do if you have a business, to be able to write off a lot of your expenses. Look up executive bonus once you get off here. It's called a Section 162 executive bonus. A quick fun fact I tell people, anything with 3 letters and 3 numbers is generally a code. Okay, and that's generally a tax code to save money. So 162 is 3 letters. Or 401, that's your 401k, that's 3 letters. Because why? 401ks are used for tax purposes. Your executive bonuses are used for tax purposes. A lot of different things out there are used. So you want to make sure when it comes to your insurance, you know which ones to use, how to have it structured, and what can be the best thing for you guys. So with that being said, I just want to do a real quick Finance Friday talking about the history of your life insurances, understanding the different life insurances and what possibly could be done. You're here with Earl, the money coach, with 2 decades of financial portfolio experience and 1 decade being licensed, helping people financially. Make sure you guys like, follow, and subscribe, and click on the description below to be able to qualify and get instant approval on your life insurances. Take care. We'll see you next time.